All right, thank you guys for jumping on here. I'm Andrew with Creekside Homes, and with me today I've got Matt Schaefer with First Security Bank. He does construction lending. I've also got Mario Rea here. He's he's an accountant and provides a lot of bookkeeping and financial planning services. And we're just looking forward to covering a few important topics that are relevant today that I think everybody would appreciate that's considering either selling or buying a home or building a home. And so yeah, we'll go ahead and jump in here. And Matt, why don't you uh, introduce yourself and tell us a little bit about what's on your mind today?
Yeah, well, thanks for having me, Andrew. And today's just going to be kind of a little short overview. I'll call it some macro trends overview, but a little bit background about myself. I've been in lending, residential lending for about 20 years. It's hard to even say that right now. I had a short stint in education, so I was a teacher for about 6 months, and that's about as long as I lasted. But definitely have taken that. I would say that training and applied that to what I do professionally, now, which a lot of what we do, and our team is coming from an educational approach. So, and probably at about worked in all facets of mortgage lending, from a broker to a bank to a small regional bank where I'm at now at First Security. And over the last about 8 to 10 years have really been focused on new construction, working with a lot of builders and construction or perm lending. So that has kind of been a niche. And with the shortage of inventory, that's kind of where a lot of our real estate is headed, which we'll kind of touch on briefly. So, but yeah, we love what we do. We believe that, real estate is definitely a way to, number one, build a home. That is a primary purpose, but secondarily, and even on a greater scale, to be able to build wealth through real estate, in our economy and in our world. So I'll jump in. I'll kind of just had a few slides to cover.
Real quick, let's hear from Mario before you do that. Mario, tell us a little bit about yourself.
Oh, okay. Well, I started off my career as a certified public accountant with one of the international firms. Didn't like working in the big firm, so I transitioned working with a regional and a local practice, and then I got cocky and started my own practice. Ran that for about a dozen years, and then I sold that and transitioned into management development work. But I really missed working. My management development work took me back into working with large multinational companies like Microsoft and Intel and HP and companies like that. I missed working with small, medium business, so I transitioned back into business coaching with small, medium business, and then started up another accounting practice because my clients weren't getting very good financial and tax work done for them. So now we have about 16 employees in our practice. We do bookkeeping, accounting, and tax work, and business coaching, business advisory services. So that's me.
Awesome. Thank you. And yeah, Matt, show us a little bit about what you had prepared here. I'm interested.
Yeah, and we can dig in and give me some commentary on it. But here, let me know if this is working. Are you guys able to see, should say 2024 lending landscape?
There we go.
Yep.
Awesome. All right, so yeah, what we'll cover, just some really high level, I call it the macro current market trends, just touch on interest rates and the lending process, not getting into the weeds, if you will, on the lending process, but more of just, what it takes to be a successful homeowner in today's market. So from a high level, the Fed just met again here last week. And so all eyes are on the Fed and every economic indicator that comes out. But if I want to rewind back to, I believe, December, when the projections for interest rate cuts were significantly greater. There was I believe the statistic was an over 80% chance of an interest rate cut in March. Fast forward to March 20, when they had met, That didn't happen. And so the reason why is because of these things that we're seeing here in terms of inflation. The Fed's goal, by the way, is to get inflation down to around that 2%. We're currently, I believe, the CPI, which is the measure of inflation, is around 3.2%. So they're trying to get that down, but the economy is still showing resilience in terms of the jobs market. I think unemployment is still at 3.9% today. So the projections have changed. And so my personal take is that I think we're going to see a higher interest rate, environment for a more prolonged period of time, because there's just going to be a lot of mixed, data out there. But that's the latest and greatest. So I think overall, though, there is a consensus that these cuts are probably going to start the latter half of 2024. Which we've all been looking forward to, especially in the residential lending side of things.
Yeah, for sure.
The other aspects
Sure.
are other things. Yeah. Any comments on that? Mario or Andrew? I know Mario, you probably got.
I think we're reading from the same. We have the same mentality with respect to that. I was a little surprised they didn't drop them, but then again, their main goal, like you said, was to keep inflation rates at a dull roar. So we may see some slight easing of the interest rates toward the latter part of the year, but I wouldn't expect anything too dramatic.
Yeah. Agreed. Higher for longer. The other fun challenge that we've been having for quite some time now is an inventory shortage. I just threw in, this existing housing units relative to population demand in U.S. Again, it's a supply and demand, and there's the population is greater than what our housing yields. There was kind of a run up in multifamily, apartment buildings and so forth. Those have been completing over the last few years. There was a reduction in the multifamily permits and so forth, but we are still experiencing a large shortage in the single family households, where a shortfall is around 3.2 million. So what does that mean? Well, that's putting pressure on continued elevated home prices. So when rates went from 3 all the way up to 8% in October of this past year, many people, were anticipating, a bubble bursting, right? And home values to be going down, but that hasn't happened. And home prices, according to FHFA, the Federal Housing Finance Administration, and the U.S. Home Price Index here, we saw an increase of 6.5% in home valuation from Q4 of 2022. So basically year over year increase. So that's still, so prices are still holding. There's no expectation that, or prediction or projection that home prices are going to be reducing. And of course, that's macroly, nationally, every market is going to be a little bit different, see some differences, but overall, holistically, home prices are holding, if not steadily increasing. The big topic, of course, is housing affordability, and we're already starting to see those changes in terms of zoning. I can't remember the exact name of the measure that was passed in Portland, but we're seeing that, Seattle, other markets, and that is increasing density, so whether it be multi-gen living, and Andrew can talk to that. I mean, we talk about this. Be curious, Andrew, actually, on your feedback on this, but the types, what we're building, the accessory dwelling units, or even multiple accessory dwelling units that you can build. And the zoning changes in Portland, for example, allow for multiple units on one tax parcel. So in line with that is changes in guidelines from Fannie Mae and Freddie Mac, who set guidelines for all of the residential conventional types of loans, and they are now allowing for even lesser of a down payment for for a 2 to 4 unit property. So a fourplex, for example, a homeowner or home buyer can purchase that with as little as 5% down. So you're seeing a lot of these things macroly, that are changing, to help promote housing affordability. So Kind of curious, Mario and Andrew, like on your guys' takes, what you're seeing, and your feedback out there in terms of affordability and what people are looking at also building, and trying to overcome those challenges.
Yeah, the what we're seeing on the construction side, because we do a lot of work with real estate and construction clients, we are seeing a proliferation of multi-family units. Still, there's a lot of inventory coming online in terms of apartments and multi-family types of units, duplexes, fourplexes, things like that. There is a proliferation of ADUs. The zoning by the cities have loosened up quite a bit, and they're allowing a lot more of the accessory dwelling units, which is basically like a studio apartment. And it can be a great way to recapture use up some of the equity in your existing home and adding that and creating an income source for you as a separate rental unit from the property, either attached to the dwelling or sometimes even a separate dwelling on the property. So we are seeing a lot of activity in that. The zoning laws continue to be a real challenge for builders. There's so many environmental things and energy requirements that are being thrust upon the builders that it's artificially increasing the cost of construction and making it more challenging to build a housing unit that's compatible with the current energy use regulations that are in place. And we don't expect that to back off, but people are getting pretty tired of having to pay extra for their housing because of these regulations that keep getting thrust upon the building community. But yeah, there's not a lot of room, especially in the metropolitan areas like Portland and Seattle, to build out. There just isn't very much land open anymore. So building up or adding multifamily things is the soup du jour.
Yeah, for sure.
Yeah, thankfully, with some of the recent bills that have been passed here in Oregon, the urban growth boundary limitations have been softened a little bit, which is going to help ease that pain just by allowing a little more supply for the demand. Is hopefully going to help with some of this inflation issue and some of the just supply issue that we're having. But speaking to the different types of properties that are being built, I'll just say for our company doing design build for folks, it's a very common thing. It was probably somewhere around half or more of the projects that we do involve making room for mom on the property, whether it's adding an ADU to an existing property or it's building a new custom home with a suite attached somehow to the property. And and of course you're trying to find that balance between having your loved ones close enough to you that if there's another pandemic type situation, you don't get this separation from your family that you can't control, and some of the horror stories that came through with all of that. But then at the same time, of course, leaving them with some dignity and some privacy, right? And so kind of that striking that balance has become a specialty for us, and certainly with affordability and zoning issues and all these different economic pressures, there's just a lot of reasons that makes sense and is a need that is definitely being filled by our company.
Yeah, for sure. I was just thinking about the house hacking is another thing too that's become a little bit more prevalent, right? I was trying to figure out, okay, with affordability, but trying to build even just any type of investment or retirement. I had a real estate agent that built a single family ADU and lives in the ADU. He's single guy and is renting out the home. So yeah, it's interesting.
There you go. Interesting idea.
So, I know I have noted election year, but we're going to keep this, podcast or webinar positive. So, but anyways, it creates volatility, and there's lots of uncertainty out there. Who knows what that's going to happen? But I'll get to a few other conversation points. But all I'll say is, obviously we can just focus on what we can control. Can't control that. So, other than maybe
Absolutely.
so. But something that's recent and is hot topic, Andrew and Mario, I'm not sure if you guys have done any research on this, is the National Association of Realtors settlement. So they just settled for $418 million. In short, what the impact is the utilization of a buyer's agent, because basically this is impacting buyer agent commission. But the reason I put that in there just as kind of a talking point, because a lot of homeowners that are going to be selling or home buyers that are going to be buying, I can distill it down to the change, and it's probably everyone has their opinions and there's still more work to be done on it, but the impact as it relates to the real estate community and the consumer is that I think our professions in real estate and even in lending are having to become actually more of a profession, right? So I think we're going to probably see shrinking of the real estate community, because you're really going to have to communicate your value to your buyers and or even the sellers in that case, but to your buyers. You're going to really have to communicate your value in what you provide to truly allow to be able to provide service and value, that would yield a commission, right? Like what service I'm going to get for what I'm being paid for. But that's kind of a big hot topic, right now, especially in the real estate community. From the consumer side, it's important because you can negotiate and your price, right? So whether that be when you're listing your home, whether or not you want to pay buyer's agent commission or not, if you're a buyer. So it could be somewhat disruptive. So Andrew, Mario, have you guys read anything, on that impact, potential impact of the NAR settlement?
Well, I think there will be some, as a result of this, there will be some falling out in the realtor market. Some people will just say, I'm not making enough money to make this worth my time. And there are basically two factions in the realty space. The realtors that are really serious about the profession, the professionals, I call them, that do really well financially and move a lot of properties. And then there's the ones that are kind of just in it part-time, a little bit here, a little bit there, and they'll move a few houses a year. The ones that have been around a long time, they'll figure it out. They'll be able to communicate and articulate their value. And they don't, the ones that I've talked to don't seem to be too worried about this.
Yeah, that's interesting. It's definitely been fascinating to watch it unfold. Would probably be a great follow-up segment to maybe have a couple realtors on to discuss further about how they're handling it and how they're navigating all that.
Yeah, that would be interesting for sure.
Yeah. No, we could do a whole podcast on that. It will be interesting to see what happens. So well, the next is, we are in a higher rate environment. We're probably in a higher for longer rate environment. So what do you do? So some things that, and this is just kind of what I do, almost a 24-year snapshot of interest rates, so, we peaked at 8% in October, dipped down in the beginning of the year, into the low sixes. Now, we're hovering around, just under that 7%, 6.9, 30-year fixed national average. But what we have been seeing over the last, year and a half, 2 years actually, is creative financing, right? So, and I'll just touch on a few things. So there are things that sellers, buyers, builders, are doing to be able to curb the challenge of a higher interest rate environment. One of those, which is a temporary buy down, and essentially all that is let's say, for example, you do a 2-1 buy down and the going 30-year fixed rate is 7%. All that means is that you will subsidize the first year payment, and it's like you're paying a 5% interest rate. The second year is a 6% interest rate, and the remaining years would be 7%. But the hope is that, ideally rates will come down. You'd be able to refinance into a lower rate, but at least can alleviate some of that delta of having a much lower housing payment or rent payment and jumping into home ownership or upgrading, if you will, and alleviate some of that impact of a higher rate. The other is just a permanent buy down, and that's just buying down the rate. So let's say at 7%, it didn't cost any points to buy down, which that's a whole nother conversation. But if you understand mortgage rates and what's offered out there, you can buy down an interest rate to below market, or you can even actually take a higher rate, and it be just less cost overall. But permanent buy downs are common, and getting there is typically through seller or builder concessions and or lender credits. So those are some things where I think over the last few years, you've had to get really strategic as a buyer and also as a seller with how you're going to market, your property. And so many listings that you'll see out there, are, offering a permanent buy down or seller concessions for, interest rate buy down. So those are some things that we're seeing to help navigate those higher rates. And it's working. I think the other thing I would just comment on is when we peaked at 8%, now 6% looks a whole heck of a lot better.
Yeah,
when we hit 6% and you're going from 3 to 6, that was very painful, but now sure. 6% is, there's a whole new appreciation for a 6% rate now than what there was a few years ago as rates were rising. So Mario and Andrew, you got any comments on what you guys are seeing with your clients and sellers, builders,
we do represent a number of realtors in our client base. So we are seeing a lot of times the seller is asking, or excuse me, the buyer is asking the seller to absorb some of the selling costs. We're seeing that happening. We're not seeing a lot of downward pressure on the price of the home, but they are asking the seller for some concessions on the closing costs to help that. And the buy down, we are seeing that happening as well. So I concur with what you're saying there. It's kind of interesting, when if we were having this conversation 15, 20 years ago, we would not be complaining about a 7% or even an 8% interest rate. The problem is that our interest rates were too low for too long, and it kind of we quit thinking about the price of the real estate, and we cared about the payment, because we could get a lot more house or pay a lot more for a piece of property with a low interest rate. And now that the rates have gone up and we've had hyperinflation in the real estate pricing, that's kind of hit us pretty hard. And it's going to take a while for us to get used to a higher interest rate, the new normal, I would say. But it's really not a new normal. It's an old normal. It'll just take some time to sort out. We might see a little bit of easing on pricing at some point, but as long as the supply and demand is the way it is right now, probably not much.
I think the interest rate is kind of turning into an indication of your age. If if this seems like a high rate to you, you're probably pretty young. If this seems like nothing, because you remember how it was 17, 18% in the 80s or the 70s or whatever, then kind of a revealer of your age, right?
Yep.
I think the average, like historical average, is somewhere around between 6 and 7%, I think. So.
Yep.
Yeah. So we just worked through it. The last thing I just touched on is kind of in our webinar agenda was just with all the, I'll call it the uncertainty in the market, in our world, right now. I mean, You got the Baltimore Bridge, just everything. I was just even listening to Darren Hardy this morning. There's so much noise out there and impact and stressors in our life. And sometimes, what you need is you just need to focus on clarity. And so, achieving successful home ownership and what does that mean? What am I talking about? So this webinar is, you could be a first-time home buyer. You could be, someone that's looking to downsize, to upsize, to build a new home, possibly with Creekside Homes. You could come in all different facets, but what doesn't change is when we talk about being a successful homeowner, that really starts in the pre-approval. And I almost want to get away from a different word because it's used so interchangeably and poorly in my opinion. But really, it's we call it kind of a hopes and dreams call, because that's where it starts. So to be a successful homeowner and have successful homeownership, that begins, I know, Mario, with what you do with your clients in terms of planning and structuring. That's such an integral part, to be successful financially. And so I just bullet pointed a few of the things that, a pre-approval provides. And it's still funny to me that a lot of people are apprehensive about doing a pre-approval because you feel like maybe there's an obligation or something like that. But getting past that, a pre-approval can provide a wealth of information for you to help make sound financial decisions, as you move forward. And so I touched on a few things. The number one thing, of course, it provides a budget, especially if you're looking at building a home. You got to start with a budget because then you need to provide that for a builder. So then they can work within the framework in designing your home and coming up with a design that's going to fit within that budget. And in terms of loan structure, that could come in a whole host of different varieties and situations on whether or not, you are going to, do you need to sell a home in order to qualify? Are you going to convert that home to an investment, property? And how do I do that? How can I access my current equity, and repurpose that for a home that I want to build or buy that meets my family's needs? So it provides a lot of clarity there in terms of just what type of structure needs to happen in order for you to achieve your goals. The credit evaluation and improvement, I get a common feedback, I don't want to start the pre-approval until I clean up some credit. Well, there's a lot of things that a lender can do to provide coaching and information to be able to help you achieve a more optimal credit score. So, and ultimately achieve a better interest rate, because interest rates are tied to your loan to value. Heavily weighted is your credit score, which is 760 and above is considered excellent in the world of residential lending. So, really important piece there. And then I'll touch just briefly on the other aspects. It really does strengthen your bargaining position, as a buyer in a very competitive market, provides a roadmap for your goals. And the way we approach our pre-approvals and consultations, much like I would assume Mario like to hear your guys' feedback, is a holistic approach. So we really encourage a combination of your financial team. And if you don't have one, we always provide recommendations, to bring in your financial advisor or wealth advisor, bring in your CPA accountant, bring in, insurance, making sure you're covered. So we're really taking a holistic approach to overall financial health. And as I noted, of course, it's never too early to begin that process and just to see where you stand, whether you're looking at doing something now, 6 months, 6 years from now. It's always great to get, a determination of where you stand right now. So your guys' thoughts, Andrew, Mario?
We just had a property move that one of my clients and I partnered on to do a rehabilitation and a sale of the property. And we got an offer on it, and the offer had a pre-approval letter from the lender, and that really makes the situation friendly. you get right down to it and say, yeah, this looks good. It was a fair offer. They've got a lender letter here. Let's move forward. We accepted the offer, and it really took a lot of the how do you say it, the challenges out of putting that deal together and making it work. So it really does make a big difference to have that pre-approval letter there. So don't be afraid to do it. And as far as, there are some things that a lot of people don't realize that they can do to very quickly bump their credit score up without too much difficulty, and get you into a space where you're ready to get a strong pre-approval letter from a lender. So working with your lender, working with your financial advisor or your accountant can really be helpful in terms of getting you ready for a home purchase. The other side to this that I think Matt mentioned was, okay, we're a homeowner now. We have a lot of equity in our home. We don't want this big of a home anymore. We want to downsize. There are lots of, and I don't know if we have enough time to go into all those. We may need to get another podcast at some point, but there are a number of strategies that you can enact to avoid paying tax or to minimize the amount of tax you need to pay on the sale of your residence if you're going to downsize.
Yeah, Mario, can you run us through, like, if somebody's got to sell a property and how much equity they might have, what are kind of the limits of that, and at what point do they end up having to pay taxes or not pay taxes?
Well, generally speaking, the gain on the sale of a residence is, you can exclude up to $500,000 of gain on the sale of a residence. What a lot of people miss is that they bought their residence, they might have paid, a very small price for it years ago. But what they don't realize is, when you take the selling price of your residence, you have to pull off all of those closing costs and everything, which are a significant amount of money. They could be, anywhere from 5 to 10% of the cost of the sale price. That reduces the gain right there. And then when you take what you paid for the property, and then what we typically do with our clients is we go through it room by room, and we say, did you remodel the bathroom? How much did you spend on that? Did you remodel the kitchen? Did you paint? Did you put in carpet? And you start adding up all of these costs that you've been spending on the home throughout the years, and it really significantly increases the tax basis such that we can really get rid of that taxable gain if they're just going to sell the house outright. The other way to avoid that is to replace it with a house that is greater in value. You can defer the gain on the sale by doing that. It's the gain gets deferred, and the deferred gain reduces the basis of the new property, but at least you don't have to pay tax on it immediately.
So what you're saying is, if somebody's got a piece of property, like maybe their current primary residence right now, and let's say they've got $700,000 in equity in that property, if they want to go and build a new home, if that new home is worth more than that current home, then they could actually roll that equity and defer the tax implications by doing that.
Correct. Or again, we go back and we say, okay, do you really have $700,000 of gain? Just because you have equity, equity does not equal gain. It's all about the selling price minus the closing costs, minus what you paid for it, minus all those improvements that you've made over the years. And as we go through those with our clients, it's pretty surprising how much of that gain you can get away with. So it's not really about the equity, it's about the gain on the sale.
That makes sense. Both of you know a little bit about options to turn your existing home into like a rental property and some of the benefits with that. Matt, I know, we've got a few clients that we've worked with that have done that sort of thing, and Mario, you obviously know how to structure those deals. Can you talk a little bit about the benefits of that and why someone might consider holding on to that existing property versus selling it to tap the equity?
Well, I think the main thing to look at it dispassionately, get rid of it as your home, because your home is your home. It's not an investment. But you have to look at it dispassionately as an investment and saying, okay, if I were to invest this money in the stock market or in mutual funds or somewhere else, given the risk profile, a certain risk profile, what return on investment could I expect at what risk rate? And I think you need to look at the rental property, same, if you're going to convert a residence into a rental property, look at it the same way. It needs to pencil out. We see a lot of clients that go out and buy a piece of real estate that has negative cash flow. And are you really getting a good return on investment if you have negative cash flow on a rental property? You don't really, you got to be careful about that. You want enough cash flow coming out so it's not costing you money to have that rental out there. A lot of times it involves either refinancing the property to pull the equity out or getting a second mortgage to pull part of the equity out and using that as a down payment on the new home and things like that. There's lots of different scenarios that we can play with respect to that, to structure it and make it work. But again, when all the smoke clears, it has to be an economically viable investment. Matt, you got any thoughts on that?
Yeah, I was actually going to screen share just something. So in pretty much every client that is sitting on, and it's case by case. So, and it's not, landlording is not for everyone, but we call it accidental landlording. And so I use my personal example. I would never, we have rental properties, but, we have a property management company. I would be the worst landlord, right? I mean, like I'm just too nice. If someone is having challenges, I don't want to help them, but it's a business. You can't operate a business, like that. But what we've been doing is pretty much, or it's kind of happened organically with clients that are sitting on, a fair amount of equity, sitting on a 3% interest rate, not wanting to give that up. And how can we take advantage of that? Right. That's the main thing. So just to your point, Mario, we look at how do we capture current equity for the next move, if you will. And then, does it cash flow? And so we did, I'll kind of screen share real quick. I'm not going to go through this in detail, but this was a client that, in short, they had a 3.25% interest rate. They bought their home in 2000, I think, 16. What we ended up determining was it did make viable sense, financial sense, to convert their current home to a rental property. They were purchasing a new construction home, took advantage of some seller buy downs, et cetera, from the builder. And when we forecast, so this is a deep analysis of, the cash on return. So it goes through a complete analysis of if you were to convert your home to a rental, we take into consideration as close as we can the estimates for all expenses, whether it's maintenance, repair, property management fee, etc. But this is the big number that it is mind-boggling here. So this is a 10-year outlook. So for Jason and Melissa to keep their home, what does it look like over 10 years? And what could they potentially yield by hanging on to that property as an investment? And your net gain, after expenses, around $414,000, right? Versus if you were to sell now, with our value being, diminished, our dollar value being diminished, versus holding on to real estate, fixed asset, So anyway, yeah, we love it. I love having those conversations, and this is where I get excited about helping clients and people, think differently, just think there's more options, especially as it relates to building, wealth, really, through real estate. So we love it. Yeah, it's a great opportunity.
That's awesome.
The thing to think about there is I liked, Matt, your illustration showing the cash on cash return. That's important. You need to have a cash on cash return, not less than usually 10% is my bottom line. 8 to 10% is, if it gets below that, then it's not cash flowing. You're in danger of having a bad investment. If you consider that with the average increase appreciation of real estate over time, then it becomes a viable investment. Real estate rental properties are not without risk. If you get a bad tenant in there, you can end up spending many thousands of dollars repairing the home and getting it ready to either sell or rent to someone else. So, having a property management firm, even though there's a charge for that, makes a lot of sense. They're really great at screening renters and making sure the rent gets collected and being the bad guy if they need a bad cop to get in there and manage that situation. That's really helpful. But making sure that you're getting a reasonable return on investment, given the risk profile, that's not a low risk. Then I think that makes a lot of sense. I like that illustration because it showed a real viable opportunity there. So going through that analysis before you jump in with both feet makes a lot of sense.
Yeah, I mean, to your point, Mario, we definitely encourage, it's not all, roses, and we definitely encourage the other side, in terms of that evaluation, like, yeah, the pitfalls of landlording and that impact. And, back to when you talked about how do we capture equity, we look at having that additional nest egg for those unprepared, unforeseen, I should say, expenses they're going to come up, right? Your hot water tank comes out. Well, you're the landlord. You got to fix it. So,
at some point you got to repair the roof. You got to, put a new roof on it. The HVAC system might be aging. The heating and ventilating and air conditioning system. So there's lots of big ticket items that could go south on you over time.
So Mario, what can you tell us about generating tax deductions by using your dream home in a business?
Let's talk about the rental home first. Most of the time, even though a rental home might be economically generating cash flow, profit, when you get the depreciation against that, it shelters a lot of that profit. And so you're getting a lot of tax-free income from that rental property. So makes it worth looking at. The downside to that is sometimes it turns it into a tax loss, and it depends on how you depreciate your property. If you just, most accountants, quite frankly, are pretty lazy when it comes to depreciating real estate, and they just take some of the land out and depreciate the house over what is it, 27 and a half years, I think, for the depreciation on a residence. Whereas you can do what's called cost segregation and componentize the different parts of the house, like the carpeting, the cabinetry, things that are going to wear out sooner than 27, 28 years. And you depreciate those at a more accelerated rate, generating more tax losses. And that can give you a usable tax loss on your personal return and get you some nice refunds going, or at least reduce your tax burden each year. There are some limitations on that, however. If you make too much money, the ability to use that loss phases out as your income gets into upper levels. Once you start getting above $150,000 of income, as an example, the ability to take that loss begins to diminish, and you lose that. I have clients that have large real estate losses that can't take them right now because their income is too high. The way around that is if they eventually sell the property, they get to recapture all those losses in the year of sale. So it doesn't go away, it just gets deferred. Or if they have a low income year, sometimes they can take advantage of those losses. Or if they invest in assets with passive income, they can use that against the losses against that passive income. So there are ways around that. That would be the main thing. The rule, whenever now the answer to your real question there, Andrew, if I take my residence and my office is in my home, so I'm one of those guys. My office, if I'm taking a home office deduction, you have to be really careful about that because you're really potentially converting your house into a business asset. And so that portion of the home, if it's 10% of your home, your square footage, as an example, that you're using for business space, that might put you into a different situation when you sell that home, because you cannot defer the gain on the sale of a business asset. And you want to be really careful about how that gets structured. So we structure it in a very sweep it under the rug kind of way to make sure that that you're not changing the character of the property from a personal residence into a business asset.
Wow, that's cool. It sounds like there's some tricky things to know about the way to handle that for sure. What about like tax credits for energy savings? I know I've had a lot of customers ask about this, but the Energy Star program and different things.
There are some credits out there. It's a fairly complex area. And I'm not a super duper expert in that, but we do have some clients that have put on solar as an example, or energy saving, heating, ventilating, air conditioning units, HVAC situations, and you can get tax credits for some of those things. Again, it's an economic decision. Some of those things are so expensive that it takes years and years and years, like 10, 15, 20 years before you get a payback on that investment. So you want to do that with discretion. It's not just about putting that stuff in there. But you want to make sure that you're getting, if you've got an existing structure, as an example, and you're going to put on solar to capture some electricity for solar, a lot of times you might spend way too much money on the system, and it takes literally decades for it to pay off. And so you got to really ask yourself if that's really a good way to go, even with the tax credit. So don't just jump out and do that stuff. Make sure you're working with your tax advisor and you're looking at it economically to make sure you're coming out ahead on that.
Yeah, absolutely. I was thinking, listening to both of you talk about this, kind of a good analogy that I see with, someone who's looking at the prospect of building a home or selling an existing property, or all of these things that we've been discussing here. It's kind of like if you go back in time to when people were deciding to move west, and take the Oregon Trail, as we call it, out to the West Coast and find a new life. It was an exciting thing for some people. Some people never did it, of course, from coming from the East Coast or the Midwest. But if you can imagine, if you spoke to someone who made the trip, you might have different perspectives, right? Like some people might tell you about, oh, it was awful, and we were attacked along the way, or someone got sick, or I lost a loved one, or horrible stories. And you may talk to someone else that it was great, we hit the timing just right, everything worked out good, we got there. But I was thinking, you could talk to someone who maybe you could talk to a blacksmith, and he might say, oh, you don't want to do that, it's going to wear out your wagon wheels. Or he would focus on like his area of expertise and telling you what you should or shouldn't do. But if you talk to somebody like a guide, like maybe a guy that's made that trip 30 times, and he knows where to buy the wagon that's going to endure the trip, and he knows what you need to pack in that wagon so that it'll survive the trip. And I was just thinking about that analogy, and how that really Matt and Mario, myself, we all kind of fill in those kind of more guide roles in this process of buying and selling or building a project. And if you talk to someone who is a little more specialized, maybe all they do is plumbing or whatever, right? They have a very narrow view of the process. They might not be getting you all the information. And the way I really apply that even is sometimes talking just to an architect, or some people want to go into like a flooring store and look at materials, or sometimes they start off maybe in a place that isn't as ideal, because again, it's very focused, right? But if you can get with a good advisor that actually sees the whole picture from where you're at today to where you're going to end up, and knows the pitfalls and the choices that you're going to have to make, that's going to get you much more valuable information. And I think the information on this call today has been really, really valuable to understand pros and cons of those things for someone looking to build or looking to buy and sell real estate.
Well, we appreciate the opportunity to share some of the experience that we've gained over the years, and hopefully we've added some value to those that are listening in here.
Absolutely.
Yeah. I look forward to the next one that we do. And Mario, great meeting you as well too.
Same here.
Your backyard. So yeah, great information. I learned something today too. So yeah.
Great.
Thanks for hosting, Andrew.
Yeah. Thank you guys. It was a pleasure.
Take care, everybody.
All right. We'll see ya.
See ya.